Top executive pay has increased 10 times faster than average worker pay in the last 40 years. That's what this image shows, and it tells us a lot about what's wrong with the UK economy. So stick with me while we tell the story. Welcome to Bonkers Economics. This is where we explore the UK's broken economy using images that I've created. And this one is called Boardroom Excesses. It's also a picture of a snail. And what it shows is the explosion in pay of the chief executives of Britain's top 100 companies compared with the pay of average workers. So what we have here, little blue box, the head of the snail, if you like, that is the typical worker pay, average worker pay in the UK. And then the yellow box here, the body of the snail, if you like, that's the number of times bigger than the average worker the chief executives of Britain's top companies were paid in 1980. So that's 11 times more. And then what we have here, the shell, the big sort of load on the back of the snail, if you like, this is the same figure now. So that's about 120 times more. So the top executives of these big companies are being paid on average 120 times more than their average worker. That's about £4 million each. So while typical worker pay has increased at a snail's pace, this pay of chief executives has rapidly accelerated at a very unsnail-like rate of progress. And another way of thinking of this is to see this as an enormous, great crushing burden on the prospects of ordinary working people, something they have to drag along with them as they go forward. However you look at it, this image tells a powerful story. So let's find out whether it really matters and whether it's a symptom or a cause of the UK's economic decline. Now, there's so much wrong on an emotional and moral level when we look at this. There's so much to get angry about. There's the inequality, there's the exploitation, there's the sheer greed of the situation. But anger is not enough to solve the problem. We need to understand why this matters and how things would be different if the situation could be changed. So let's start with the numbers. Well, this big block here, that's about £400 million. That's £4 million per chief executive, as I say. Now, when we're discussing numbers like this, £400 million or £4 million, it's easy to get stuck in not being quite sure whether they're big numbers or small numbers. Because obviously £4 million, well, that's an enormous amount to be paid for a year. But on the other hand, £4 million divided by, say, 100,000 workers, well, that's only £40 each, which is maybe nice to have, but it's not a game-changing sum of money. And in any case, there's precious little chance that that money would get spread around the workers if it wasn't paid to the chief executive. After all, it's the chief executive's job to keep costs as low as possible, and that includes keeping staff wages as low as they can. So much more likely, in fact, that these salaries are coming out of the pockets of shareholders and their dividends. And given that shareholders generally get a vote on how much the chief executive is paid, then we have to assume they're not too bothered by these huge sums. And that's not surprising because these companies, they could be paying out £1 billion a year in dividends, and so £4 million is frankly neither here nor there. And that's particularly so when you bear in mind that these enormous pay packets, well, they're made up of bonuses and share options and things like that, things which are directly related to the share price of the company. So what the shareholders are doing by giving their executives these huge salaries is they're tying their interests very closely to their own. So how does that work? Well, let's say these shares are trading for £1 each, and you give the chief executive the right to buy shares at £1 at some point in the future. And maybe in 2 years' time, these shares are trading for £2 each, so they can buy shares for £1 and they're worth £2, so they can pocket the difference. Or you could just give the chief executive some sort of bonus scheme and say that they will get a certain sum of money if the share price reaches a certain level at a point in the future. In either case, the incentive for the executive is to get the share price as high as possible, which is what the shareholders generally want. After all, high share prices, that's a good thing, isn't it? Isn't that what the media is always telling us? Sure, but good for whom? I mean, that's a question that can be answered in all sorts of different ways. For a start, getting on for 2/3 of UK listed shares are owned by foreign investors. So yeah, higher share prices are good for them, that's for sure. But if you think that higher share prices are good for your pension, well, think again, because only about 2% of UK listed shares are owned by UK pension funds. So ordinary people in the UK, they're not really benefiting from these higher share prices. But what ordinary people are doing is they're buying from these companies and they're selling to these companies, and of course they're working for these companies. And they're also making use of services provided by the government, which depends upon the government's capacity to raise taxation. So how the company behaves, that does make a big difference. And if you're a top company boss, then you've got two ways of increasing your share price. You've got the easy way and the hard way. The hard way, well, that's to upskill your workforce, to increase productivity, to develop innovative new products, to develop positive long-term relationships with your suppliers, to provide good service to your customers, and generally to invest for the long term. This can take years of patience and diligence and effort and money, and there's quite a good chance that your share price will go down a bit as you go through the process too. So the much easier way is to reduce staff wages and benefits, to outsource whatever you can, to increase your prices, to do your best to squeeze your suppliers, to reduce their prices to you, and generally to set up complex cross-border arrangements to reduce your tax liabilities. And rather than reinvesting any money you've got in research or staff training or new equipment or development, well, it's much, much easier to use that money to buy back your own company shares in the market. That's an almost guaranteed way of increasing your share price, and it requires basically no effort at all. There's more about that in a recent Bonkers Economics video about bank profits. So, given that most management incentive schemes, they run for relatively short periods of time, which of these two options are you going to choose? Well, you're going to go the easy route, obviously, if you can. Why bother to create real new value in the economy when you can just strip out some of the value that's already there and increase your share price in that way? And this takes us into a subject that comes up repeatedly in Bonkers Economics, which is the difference between extractive activity in the economy and productive activity. So just hang on there for a minute and we'll quickly unpack what that means. So productive activity is what we've called the hard way, creating new real wealth in terms of products and services and spreading the benefit of that activity throughout the supply chain to customers, to producers, to suppliers, and to the staff, as well as to shareholders. Extractive activity is the easy way. That means not adding anything new in productive terms, but squeezing what you can out of the existing supply chain into the hands of already wealthy investors. So what this image reveals, therefore, is a not so subtle shift in the objectives of chief executives since the 1980s to the current day, where the emphasis is no longer on producing real long-term value in the economy, but stripping out as much money as you can in order to increase short-term profits. And the sort of long-term investment in new talent, in new processes, in new products is very much a secondary consideration. It's expensive, it's risky, and frankly, it's just too slow. And this is not to say that those bosses back in the 1980s, that they weren't focused on shareholder value in a similar sort of way. But what has changed is the regulatory environment. What has changed is the rules of the game by which they operate. So we now have investor-friendly tax regimes and a sort of corporate and political culture in which short-term gain is heavily prioritized over long-term investment. And these changes, well, they're a direct consequence of the market deregulation in the 1980s and 90s and the mass sell-off of public assets that took place at that time. Instead of using these assets to create new value, the trading of assets such as land and companies and loan books, well, that's become a primary economic activity in its own right. After all, it was the trading of mortgage loan books that led to the financial crisis in 2008. And since then, we've seen the rise of private equity capital and the buying and selling of companies and the sweating of their assets and loading them up with debt. And if you wanted a good example of companies that use financial engineering to increase their returns to shareholders while neglecting investment and the development of their business, then you need look no further than the English water companies, since they were privatized in 1989. There's a whole video on this in the Bonkers Economics channel too. So that's extractive activity, stripping out real value in return for a short-term boost to the share price. And I guess what you may be asking is, well, isn't that just how capitalism works? Isn't that just what the deal is? So let's look at that question, and we'll be delving into a bit of history on the way too. So yes, it's true that people who have money do generally do everything they can to get the best return on their capital. And if that involves asset stripping or fancy financial maneuvers cross-border or reducing terms and conditions for employees, and if it's all being done by some rather remote board of directors whom you don't personally know, then it's easy to close one's eyes to the wider consequences. But before we conclude that this behaviour is inevitable, we just need to remember that the economic system, the way this operates, is not some sort of God-given system that's cast in stone. It's a system that we have created for ourselves, because pretty much the whole economy is regulated in some way. There are rules governing everything from tax to product quality to stock market trading. So the economy, or the system at least, is something we've created. And if we don't like the way it's working, then we can definitely change it. And if we want to see how we've created it, well, let's just step back briefly into the mid-19th century, when the concept of a limited liability company first came along. So we're all familiar with the word limited after the name of the company, or the slightly longer form PLC, which means public limited company. But do we really understand what that word limited means? So what it means is that the shareholders in the company are not liable for the company's debts beyond the initial amount of their investment. So if 100 people put £1 each into a company and the company trades and makes £200 of losses, well, those shareholders, they'll lose their £1 investment, but they won't be liable for the rest of the losses. They won't have to make up the extra money. And it's not hard to see how this system came about. We're talking about a time when aristocratic landowners, who historically had taken most of their income from the land, they're starting to look to industrial ventures. And often they've got very little idea what they're doing. They're looking to make money, but they're getting caught up with middle-class entrepreneurs whom they don't really trust, doing things that they don't really understand. And since Parliament at the time was dominated, both the House of Commons and the House of Lords, dominated by these rich aristocratic families, well, they came up with this concept of limited liability to ensure that they could do this sort of investing without risking everything that they had. And because of that, now almost every company has limited liability. And that also includes lawyers and accountants and other partnerships that for a long time were excluded. So we can see how invented the rules of the economy are. And what's been invented can clearly be reinvented. So let's look at that next. Of course, there is a good reason for limited liability. The idea was to create space for people to do innovative things, to develop new products and services, to take commercial risks, and to do things that would benefit society and not to carry all the risk if things went terribly wrong. So limited liability is intended to be a social good. And society gives this enormous privilege to people who form companies because it thinks that something good will flow from it. And that good thing is a bigger, stronger, more productive economy, which in principle at least will make us all better off. But it also means we need to be careful when we bandy around phrases like capitalism or free market economy. Because an economy built on limited liability is not really a free market in the strict sense. We all have to pick up the debts of companies that fail, and we don't have any choice in that. And it's not pure capitalism either, because the people putting up the capital are not carrying the full burden of the risk. So the UK economy, like every economy, is managed. It's managed for public benefit. And if people forming companies want to enjoy the privilege of limited liability, then they can and should be held to a strong test of public benefit and social utility. And to what extent is it in the public interest that chief executives should be incentivized to run their companies largely for the purposes of wealth extraction? Wouldn't it be reasonable to expect that the privilege of limited liability, the privilege of being able to dodge one's debts, should only apply to companies that are run with the public interest very much in mind? And as a minimum, shouldn't that test of public interest be whether the company is trying to build the real wealth of the economy rather than trying to strip out that wealth in the interests of foreign investors? It's an important question, and the reason for raising it is to remind ourselves that our economy is not as free as we think it is. It's fundamentally rules-based, it's regulated in all sorts of ways, and those regulations are imposed by the government. And so the government can change them, and it can change them in the public interest. All it needs is the courage to give it a try. So, thank you for watching. If you've enjoyed the video, please do press the like button because that's really helpful, and please do subscribe to the channel if you haven't already done so. And please do tell your friends, your family, anybody you think might be interested. And please do check out the website, which is bonkerseconomics.net. There you will find the data behind all the images, such as this one. You'll find the whole series of images and you'll find information about the entire project. Thanks very much.